There's a lot of videos online regarding this topic. So today I'm going to talk dividends, my process for finding them, screening them, and analyzing them for potential buy. Today we'll do something a little bit different and we'll head over to this website. This is dripinvesting.org. That's Dividend Reinvestment Program. And the first thing we're going to do is go to Info, Tools, and Forms. Dividend champions are companies that have increased their dividends every year for the past 25 years. Contenders have increased theirs every 10 and challengers every 5. So the idea for this spreadsheet was created in 2008 by Dave Fish and is now available and updated every Friday afternoon at Dividend Radar. So I would recommend looking at the site on your own, but for now we're going to take a look at Dividend Radar. And so what we're going to do is download this latest radar. Once we have that, we'll go back to Google Sheets and you can use Excel if you like. First, we're going to go open. We'll select that file that we just downloaded. Once that opens, it'll look something like this. I do run Dark Reader on my browser. That's why it looks a little bit different. And so they got some nice tabs here for champions, contenders, challengers, all of them put together, leaders based on total returns. If there's any additions to this group, so companies that are increasing their dividends for 5 or more years, and then cuts. These are companies that have been cut from the list, which is good to track. But the first thing we'll do is go to the All tab. And because we're all about saving time here, we're going to create a macro so that when we do this perhaps every week, we can run our macro and save ourselves a lot of time. So we can select cell A3 and we can drag everything over to industry and then go to data, create a filter. Now we can start sorting these companies because you might feel tempted to just go right to dividend yield and just say, hey, give me the highest yielding, highest paying company that I can find. Strongly advise against that. And I'll talk about a couple of those things as we're going through the spreadsheet, but you don't just want to pick the company with the highest dividend because that isn't the full story. They might not be able to sustain that. Their payout ratio might be very high to where they are paying perhaps half their earnings in dividends, which is not good for growth and not great for those dividends long term because at some point they may have to cut them or stop paying them entirely. But this spreadsheet gives you a lot of good information for these companies, the sectors, the number of years they've paid these dividends, the current price, the yield, 5-year yield, current actual amount that they're paying, how many payouts per year, what it is annualized, when the last increase was, the 52-week range for the stock price, the dividend growth, which is very important, which is what we're targeting for 1 year, 3 year, 5, and 10. Trailing returns are the fair value, performance, profitability, financial strength, and valuation. Okay, now before we start screening these companies and whittling them down, we just need to reset this spreadsheet so we can start our macro. So I'm going to go back to this filter and say remove filter. We're now going to record our macro. So we'll go extensions, macros, record macro. Absolute is fine and it's recording. So that's all good. So now, once again, we'll select that first cell, drag it over to industry, data, create filter, and we can start reducing this list considerably. So here with PEG, we'll go filter by condition, and we'll say is between 0 and 1. For price to book, then Graham would say 1.5 or less. But for our purposes here, we're going to say is between 0 and 2. For our PE, filter by condition, and we'll say greater than 0. For our return on total capital, we're going to say greater than or equal to 0. That'll give us everything that has a return. Next, our debt to capital. And for this, we're going to say between 0 and 1. And what this is saying is for this company, for example, Capital Southwest Corporation, it has 57 cents of debt for every dollar it has in capital. So you obviously want that on the lower side, but by the end of this list, we're only going to have a few companies left. So next we need our current ratio. And for this, we're going to say is greater than or equal to 2. And this is telling us that the company has twice as many assets than liabilities. Next, we need return on equity. And for this, we can say is greater than 0. Cash flow per share, we want greater than 0. Profit margin, greater than 0. And for 1 year revenue, we'll say greater than or equal to 0. And for 1 year EPS, greater than and equal to 0. Reason why here I'm saying greater than or equal to is because this data is not perfect. I have found a few minor mistakes. And sometimes for companies that actually do have earnings growth for the trailing 12 months, it comes in at 0. So if you just say greater than or equal to 0, then you'll be good to go. Okay, next we're going to filter for our chowder number. And so what a chowder number is essentially the 5-year average dividend growth plus the current dividend that they're paying in yield. And so obviously for that, the higher the better. So we're going to say greater than or equal to 12, and we narrow down. And then for fair value, we're going to filter by text does not contain, and we'll say above. And that'll take anything that is above fair value off of our list. So now we have a pretty narrowed down list of companies, something manageable that we can analyze. And all these companies are in pretty solid financial footing at the moment based on what we can see. And if you look at the dividends column, these numbers are not very high, but that's okay because really we're targeting both growth for the company itself and for the dividends. And so these companies are going to have very low payout ratios, so they can both pay the dividend out and they can reinvest their capital into their company, into new products, and generate more revenue. So all of this is good for us for the long term. And then lastly, to close our macro out, we'll just go to our chowder number and sort highest to lowest. Okay, now we will save our macro. We'll call this chowder. Okay, now that we have our macro, let me show you real quick how to import that into a new document. There's probably an easier way to do this, but this is the way that I do it. You can go to macros, manage macros, chowder, edit script. We'll control A, we'll copy it, close it, hit cancel. We can go back to our Dividend Radar. Let's get a new copy. Back to Google Sheets or Excel. Go open, select the new Dividend Radar. Back to the All tab. And here we'll go up to App Scripts. Just delete everything that's in there. Control V to drop in our new macro. Rename macros, save, close it. So we're back here as if we just downloaded a new Dividend Radar. Go to our extensions, go import macro. There's chowder, we'll import it. Now we can go to our macros, we can run chowder. It'll likely ask for permission to run this, and that's fine. You can hit OK. And then we'll go back to extensions and we'll run chowder. And this will save us a lot of time by not having to sort every new list that comes out. So now we're back to where we were. All right, let's take a look at these companies and I'll give you my quick take on them. First, Schneider National. This is a trucking company. Industrial, pays a 1.3% dividend, pretty low PE. High PEG, this isn't great, but they have a low payout of 11%. That's not bad. Return on equity, 19%. Petrosky of 8, Altman 4.2, earnings yield of 15, return on capital 24%, acquires multiple of 6. So it looks interesting. Let's keep checking. UFPI, it's Universal Forest Products, 8% payout. Petrosky of 8, Altman 7.1, earnings yield of 17%, return on capital 36. Very nice. DHI, this is DR Horton, consumer cyclical. So this is residential construction, payout of 6, earnings yield of 20, ROC 35. Pretty nice there. Petrosky of 5, not great. Shoe Carnival, very nice. Payout of 6, Petrosky 5, Altman 3.6, acquires multiple 5. Earnings yield 20, return on capital 28, and a return on equity 32%. Very nice. Let's keep going. STLD, Steel Dynamics, PE of 4. PS next year, looking at a negative 53%. That's not very good. That's looking at a hard economic downturn, recession, but an acquires multiple of 3. Petrosky of 7. High earnings yield and return on capital. That's all good. RS, that's Reliance Steel and Aluminum. Also very nice. Payout of 10%. So a lot of room to grow, a lot of money to still invest in the company. Return on equity of 30, earnings yield 19, return on capital 45. All that's very nice. A very high peer comparison number in its field. That's all really good. Last couple, try Winnebago. Very low PE, 5% payout. 33% return on equity. Very nice. High earnings yield, high return on capital. Petrosky is 6, Altman 4.9. So this company looks very interesting. It's all very nice. Only downside there is higher interest rates, perhaps less people buying Winnebagos, but on the bull side, a lot of people having issues with affordable housing and might choose the Winnebago as the alternative. And lastly, Pulte Group, PHM, payout of 6%. Nice earnings yield, return on capital, nice low, acquires multiple. Petrosky at 5, Altman 4. So it looks interesting as well. So for these companies, obviously I would do a lot more research, but all these companies are in decent financial shape. So that is it for my dividend portfolio process. I hope this was helpful. I'll have everything I went over here in the description. Let me know in the comments or shoot me a message if you'd like to see anything else. And I appreciate it. Thanks. Bye.